If you've ever watched a stock ticker, you know it can look like a nervous insect, jumping up and down for reasons that seem to make no sense at all. One day, your favorite company is up 5%, the next it's down 3%, and you haven't heard a peep of news either way. It's enough to make anyone think the whole thing is a giant casino. But the secret to the stock market isn't about guessing the next jump. It's about understanding that the market has different personalities depending on the time frame you're looking at. What matters for a stock's price today is often just noise when you look at its performance over a decade. The trick is knowing what to pay attention to and when. Think of it like this. Predicting if it will rain in the next 10 minutes is all about looking at the dark cloud right above your head. Predicting the climate for the next 10 years requires understanding much bigger forces, like ocean currents and atmospheric patterns. The cloud doesn't tell you much about the climate, and the climate doesn't tell you if you need an umbrella right this second. Investing is the same way. The daily chatter, the hot tips, the stock of the week, that's the passing cloud. The real, long-term success comes from understanding the durable, fundamental weather patterns of a business and the economy. This idea is the most important tool you have as an investor. The professionals on Wall Street, with their fancy terminals and constant stream of data, are often obsessed with the next 10 minutes. They have to be. But you, the individual investor, have a tremendous advantage. You can afford to ignore the daily squiggles. You can focus on what a company will look like in 5, 10, or even 20 years. By understanding that different factors drive stock prices over different periods, you can tune out the distracting noise and focus on what truly builds wealth over the long haul. In this essay, we're going to peel back the layers of the market onion. We'll start with the short-term franticness and move all the way out to the slow, powerful forces that shape fortunes over a lifetime. We'll look at why a company's stock might go down after a great earnings report, and why another might plod along for years before suddenly becoming a 10-bagger. That's the holy grail, a stock that goes up 10 times its original value. By the end, you'll see that the market isn't as random as it looks. You just need the right map for the right journey. In the short term, the stock market behaves like a hyperactive teenager, reacting to every little thing with dramatic flair. The price of a stock from one day to the next is often a story of emotion, not logic. This is the world of market sentiment, which is just a fancy way of saying how investors are feeling. If a scary headline about a potential recession hits the news, people get nervous and start selling everything, good companies and bad ones alike. The next day, a positive government report comes out, and suddenly everyone is optimistic and starts buying again. These mood swings are the engine of daily volatility. Another major player in the short-term game is the constant drumbeat of news. A company announces a new product and the stock might jump. A competitor cuts its prices and the stock might fall. Sometimes the reasons are even flimsier. I've seen stocks move because a well-known analyst on a TV show mentioned the company's name, either with a smile or a frown. These analyst ratings and price targets can cause a flurry of buying or selling, even if nothing about the company's actual business has changed one bit. It's all about perception in the here and now. Then you have the quarterly earnings report, which is the company's report card every 3 months. You'd think a good report card would make the stock go up, right? Not always. Wall Street analysts make predictions or estimates of what the earnings will be. If a company earns $1 billion but was expected to earn $1.1 billion, the stock might go down. It's a crazy game of expectations. The short-term crowd isn't asking, is this a good business? They're asking, did the company beat the whisper number? It's a frustrating spectacle, but it's how the daily game is played. So what does this all mean for you? It means that trying to predict or react to these daily movements is a fool's errand. You can't outguess the collective mood of millions of people, and you'll drive yourself crazy trying. This short-term noise is what scares people out of perfectly good investments. They see a great company's stock drop 10% in a week because of some market-wide panic, and they sell at the worst possible time. The key is to recognize this daily action for what it is, mostly sound and fury, signifying very little about the company's long-term future. Once you stretch your time frame out to about a year, the daily noise begins to fade a little, and the actual performance of the business starts to enter the picture. Over a few quarters, you can't fake it. A company either is or isn't growing its sales and making more money. While a single earnings report can be misleading, a trend over 3 or 4 reports starts to tell a real story. Is the company consistently beating expectations? Are its profits growing at a healthy clip? This is where fundamentals, the nuts and bolts of the business, begin to have their say. This is the time frame where you start to hear people talk about a company executing on its plan. Maybe a retailer said it was going to open 50 new stores this year. A year later, you can check. Did they do it? Are those new stores attracting customers? A software company might have promised to launch a new version of its flagship product. Did it launch on time, and are customers upgrading? These are tangible results, not just feelings or rumors. The stock price over a year will often start to reflect whether the company is keeping its promises and delivering real growth. This period is also where you might see a story start to validate itself. Let's say you invested in a restaurant chain because you noticed their parking lots were always full and they were expanding into new towns. In the first few weeks, the stock might go nowhere. But over a year, as they report quarter after quarter of strong sales growth from those new locations, Wall Street starts to catch on. The numbers prove your initial observation was correct. The story transitions from an interesting idea to a documented success, and the stock price tends to follow suit. However, the 1-year mark can still be tricky. A company can have a great year, but if its stock was already priced for perfection, it might not go up much. This is where valuation starts to creep in, which we'll discuss more later. A stock's performance over a year is a mix of its business results and the market's initial expectations. But the key takeaway is that we've moved away from pure emotion and into the realm of evidence. The company's report card is now more important than the market's daily mood swings. When you look at a stock over a 5-year period, the picture changes dramatically. The short-term noise becomes almost irrelevant. What really matters now are 2 powerful forces: the company's ability to grow its earnings and the price you paid for those earnings. A company that can consistently increase its profits year after year is like a powerful engine that will, sooner or later, pull the stock price up with it. You can't ignore sustained growth. A company that doubles its profits over 5 years is very likely to have a much higher stock price than it started with. The other half of the 5-year equation is valuation. This just means, how cheap or expensive is the stock relative to its profits? You'll hear fancy terms like the price to earnings or PE ratio, which is a common yardstick. If a stock has a PE of 10, it means you're paying $10 for every $1 of the company's annual earnings. If its PE is 30, you're paying $30 for that same dollar of earnings. Over 5 years, these multiples matter. Buying a fast-growing company at a reasonable price is a recipe for success. Buying a great company at a ridiculously high price can lead to years of disappointing returns, even if the business does well. Think about it with a simple example. Imagine 2 companies, A and B, both earning $2 per share. Company A is a steady slow grower with a stock price of $20, a PE of 10. Company B is a hot tech company growing much faster, with a stock price of $80, a PE of 40. Over the next 5 years, Company B's earnings grow impressively to $6 per share, but investors are no longer willing to pay such a high multiple, so its PE drops to 20. The new stock price is $120, a 50% gain. Meanwhile, Company A's earnings only grow to $3 per share. But because it was so cheap, its PE expands to 15. Its new stock price is $45, a 125% gain. The boring company was the better investment. This interplay between growth and value is the heart of medium-term investing. The best investments are often found in companies with good growth prospects that the market hasn't fully appreciated yet, what you might call growth at a reasonable price. Over a 5-year stretch, the fundamental story of the business takes center stage. Is the company gaining market share? Are its profit margins expanding? Is it generating more cash? These are the questions that determine whether you'll be a happy investor 5 years down the road. The daily headlines are long forgotten. When you extend your investment horizon to a decade or more, you enter a new dimension. Here, The year-to-year fluctuations in earnings growth become honestly less important than the enduring qualities of the business itself. The first of these is the quality of the management team. Are the people running the show smart, honest, and passionate about the business? Do they think like owners, carefully investing the company's capital for long-term returns? Or are they just trying to hit their quarterly targets to get a big bonus? Over 10 years, a brilliant management team can create enormous value, while a mediocre one can, unfortunately, run a great business into the ground. Next comes the concept of a moat, a term popularized by Warren Buffett. A moat is a durable competitive advantage that protects a company from competitors, just like a real moat protects a castle. It could be a powerful brand name that everyone trusts, like Coca-Cola. It could be a patent that keeps rivals at bay, like a pharmaceutical company has. Or it could be a low-cost advantage, where a company like Walmart can sell goods cheaper than anyone else. A wide moat allows a company to earn high profits for a very long time, and that is, honestly, the secret sauce to truly spectacular long-term returns. Finally, and this is something you won't find on a balance sheet, there's company culture. This is the invisible fabric that holds a business together. Does the company treat its employees well, fostering loyalty and innovation? Is it obsessed with customer satisfaction? A strong positive culture often leads to better products, happier customers, and lower employee turnover, all of which contribute to sustainable success. A toxic culture, on the other hand, can rot a company from the inside out. You can often get a feel for this by visiting a company's stores, talking to its employees, or seeing how it handles customer complaints. These three factors, management, moats, and culture, are what separate the good companies from the truly great, enduring enterprises. A company might have a few good years of growth, but it takes these deep fundamental strengths to prosper for a decade or more. This is why it pays to invest in businesses you understand and admire. If you find a company run by great people, with a product that's protected from competition and a culture that you respect, the odds are very good that you've found a winner for the long haul. The stock price will eventually take care of itself. Beyond the specifics of any single company, there are massive universal forces that act like the tides and currents of the ocean, affecting all stocks to some degree. The most powerful of these is interest rates. Think of interest rates, set by central banks like the Federal Reserve, as the financial world's gravity. When rates are very low, money is cheap to borrow, which encourages companies to expand and make stocks look more attractive compared to the paltry returns from a savings account. But when rates go up, borrowing becomes expensive, slowing the economy, and safe government bonds start to look like a pretty good alternative to risky stocks. This is why the market often gets jittery when the Fed is about to make an announcement. Another fundamental force is simple supply and demand. There are only so many shares of a company available to buy. If a lot of people suddenly want to buy that stock, perhaps because it's been added to a major index like the S&P 500, forcing index funds to buy it, the price will be pushed up, regardless of the company's fundamentals. Conversely, if a large early investor decides to sell their entire stake, the flood of new shares for sale can push the price down, even if the business is doing great. This is the raw mechanics of the marketplace at work. Of course, the overall health of the economy, the macroeconomic environment, is hugely important. When the economy is booming, people have jobs, they spend money, and corporate profits soar. This is a tailwind for almost all stocks. When the economy enters a recession, spending dries up and profits fall, creating a headwind that can pull down even the best companies. Things like the unemployment rate, inflation, and consumer confidence are all pieces of this larger economic puzzle. A rising tide lifts all boats, and a falling tide can leave even the sturdiest ships stranded in the mud. Finally, we can't ignore the role of mass investor psychology. Sometimes, a mania can take hold, where investors become irrationally exuberant about a new technology or trend, like the dot-com bubble of the late 1990s. They bid up stock prices to astronomical levels that have no connection to reality. The opposite can also happen, where a market crash creates a climate of fear and panic. causing people to sell everything at bargain basement prices. These psychological waves can be the most powerful force of all in the short to medium term, overriding everything else. It would be nice if all these different factors stayed in their own neat little boxes, but the reality is that they are all tangled up together in a complex and sometimes confusing web. The forces often interact and can even work against each other. For example, a company might report fantastic earnings growth, a huge positive for the medium term, but on the same day, the Federal Reserve might unexpectedly raise interest rates, causing the entire market, including our great company, to fall. The universal force of interest rates temporarily overpowered the company-specific news. Consider another conflict. A company with a wonderful long-term moat and brilliant management might be in an industry that's currently out of favor with investors. Think of a well-run oil company during a period when everyone is excited about green energy. The company might be a cash-generating machine, but its stock could languish for years simply because of negative market sentiment and macroeconomic trends pushing investors elsewhere. The short-term mood can obscure the long-term strength, creating a frustrating situation for shareholders, but also a potential opportunity for patient investors. The interaction also works in the other direction. Strong company fundamentals can eventually overcome a negative market environment. A company that continues to grow its sales and profits right through a recession will eventually get noticed. As other companies falter, its strength will stand out even more. When the recession ends and optimism returns, these are often the stocks that lead the market higher as investors flock to proven winners. The company's 5-year growth story ultimately triumphs over the 1-year macroeconomic headwind. Understanding this tangled web is crucial. It helps you make sense of a world where a stock can go down on good news or up on no news at all. It teaches you to ask the right questions. Is my stock falling because the business is in trouble, or is it being dragged down by a general market panic? Is the stock rising because the company is truly innovating, or is it just part of a speculative bubble? Recognizing which force is dominant at any given time is a skill that separates the amateur from the savvy investor. It allows you to see the bigger picture and not get shaken out by confusing crosscurrents. So, with all these conflicting forces pushing and pulling on stock prices, how can an ordinary person possibly succeed? The answer is by using the one advantage you have over most of the professionals on Wall Street: time. A fund manager often has to worry about their performance this quarter or this year. If they have a bad stretch, their clients might pull their money out. This forces them to focus on the short-term game, the daily noise and the quarterly earnings beat. They simply can't afford to wait 5 years for a great story to play out. You, on the other hand, can. You are your own fund manager, and you don't have to report your quarterly performance to anyone. This freedom allows you to completely ignore the short-term circus and focus on the factors that drive wealth over the long haul. You can buy a stake in a wonderful business you understand, run by people you trust, and simply hold on as it grows over the next decade. You can let the power of compounding earnings work its magic without getting sidetracked by market sentiment or a single disappointing quarter. Time is not your enemy, it is your greatest ally. This long-term perspective also makes you a smarter, calmer investor. When the market inevitably panics and stocks are falling across the board, you won't be tempted to sell everything in a fit of fear. Instead, you'll see it as an opportunity. You can ask yourself, has the 10-year outlook for my favorite company changed because of this panic? Does it still have its moat? Is the management still excellent? If the answers are no, then the market is simply offering you a chance to buy more of a great business at a discount. A market panic is the long-term investor's best friend. Embracing time as your strategy means doing your homework up front. It means focusing your research on the things that last, the company's competitive advantages, the quality of its balance sheet, its growth potential over 5 or 10 years, and the integrity of its leadership. Once you've done that work and made your investment, you can relax a little. You don't need to check the price every day. You can check in on the company's story once or twice a year to make sure the long-term thesis is still intact. This approach is not only more profitable, it's a lot less stressful. Investing can seem impossibly complex, but at its core, it comes down to a simple idea. A stock is not a lottery ticket. It's a small piece of ownership in a real business. In the short run, the price of that stock can be tossed around by rumors, emotions, and Wall Street's guessing games. It's like standing in the middle of a forest and only looking at the leaves rustling on a single tree right in front of you. You'll see a lot of motion, but you won't have any idea where you are or where you're going. It's confusing and easy to get lost. The key to successful investing is to take a step back and see the entire forest. When you do, you realize that the long-term health of the forest depends on bigger things: the quality of the soil, the amount of rainfall, and the strength of the trees themselves. Similarly, the long-term value of your investment is determined by the durable fundamentals of the business, its growth, its profitability, its competitive moat, and the broad economic environment it operates in. The rustling leaves are just noise. The health of the forest is what truly matters. Therefore, your job as an investor is to train yourself to focus on the forest. When you read about a company, ask yourself questions that relate to the long-term picture. Will people still be buying this product in 10 years? Does this company have a clear advantage that will be difficult for competitors to copy? Is the management team making smart decisions that will benefit shareholders a decade from now? If you can answer yes to these questions, you've likely found a sturdy tree in a healthy part of the forest. Don't be intimidated by the experts on TV who are constantly debating what the market will do next week. They are playing a different game, a short-term speculative game that is very difficult to win. Your game is a long-term ownership game. By understanding what moves prices over different time horizons, you can choose to play the game that gives you the best odds of success. Focus on great businesses, buy them at reasonable prices, and let time do the heavy lifting. If you do that, you'll be well on your way to building real, lasting wealth.